Hello, everyone. Welcome to another episode of Sharing Session. Today, here with me again, Nicholas. And today's topic is something that is very topical, something that is happening, and something that everybody is talking about last night. So we just wanted to highlight our point of view as well. We are talking about inflation. So later, Nicholas will actually bring us through a number of key points. So what we want to cover today is basically the latest update on inflation numbers. And I guess most of you would already if you are kind of like keeping track, you will probably know that the inflation numbers are actually running higher than the market expectations, but that doesn't seem to actually affect the market, so to speak. So that's something that we'll be talking about more in depth later. And we also be talking about, does that actually point to transitory or something that is more structural in nature? So the Fed believes that it's going to be transitory, or potentially, is that going to be right or is that going to be wrong? So that's something that we discuss. And last but not least, again, what do we do right now? That's something that I will actually bring you through in terms of if inflation is really running hot, what are some of the investments that you can actually look to consider for your portfolio? Okay, so without further ado, I will actually hand it over to Nick to actually talk about inflation numbers. Nick, over to you.
Okay, thank you very much, Royston, and thank you for having me once again. And folks, let me just remind you, at the end, Royston will probably give you some good ideas on basically how one should be considering structuring their portfolios, purely because I think we're going to go into quite tough times ahead. But anyway, before I start, as always, just a word of caution and disclaimer that we are just sharing education and information basis. What constitutes our view. Our view may not be necessarily something ideal for you, but it's something that I think you should take into consideration before taking any action in some of the things that we're going to talk about. Please seek your own investment advice. Okay, let's just jump into the numbers. This is what Royston was talking about. Last night, this happened. A very hot number of 5% inflation reported for the month of May. Hot, why? Because if you look at it, just back in 6 months ago, we were just meandering around the 1.5 sort of level or so. Okay, but still, let me just remind you, the markets did not react in any sort of alarm, panic whatsoever. Why? Because everybody believes in one word, the word out down there, that inflation for this period of time is going to be transitory. This is a word that the Fed, Mr. Powell himself, has shared from time to time, saying that, hey, because of COVID, the lockdowns, the supply chain bottlenecks, for example, okay, prices have gone up. But this is only going to be momentary, temporarily, until the reopening happens in full force. And the reopening has actually progressed in a much better way in the Western world. Singapore, we are starting to see that and starting to feel that, and thank goodness for that. Okay, so the view of the Fed is that this number will come down and sort of moderate in the months ahead, and as such, no reason to panic. That's what the market believes. Very quickly, let's go on to the next slide. And just a quick breakdown, essentially, folks, of price components of inflation, or rather the components of the CPI index, for example. And you can see this nice real graphic down here, food at 15%, housing at 42%, a big number, okay? That essentially is where it takes the cake, food and housing itself. But yet, one point I want to point out, food, which is so important to us, has not really tickled the CPI number. As you can see from the chart below down here, food in the month of May has actually took a big dip. Confused? I'm just as confused. Does this mean, because obviously food is important for us, does this mean that in the months ahead, because we are paying less for food, net inflation will moderate? Well, I'm not in the US, so I really do not know. But essentially, what does the market say? What has the Fed done? Or what we think the Fed should be doing? What is the role of the Fed to begin with? Should they be reactive, waiting for numbers to come out, showing a higher number, in the months of June, July, August, before they start reacting? Or should they be proactive? To me, folks, the Fed has been completely non-active at all. And I think that's where one of the danger is in this market. Because if you were to go into the Fed policies, this is something Google from the Federal Reserve website, okay? One of their key functions, okay, is to manage monetary policy and economic activity, okay? But the key word down here is this: they should manage it to the point of creating stability, okay? And stability in financial markets, for example, and financial system for that matter, okay, has everything to do with how they manage inflation and inflation expectations. Based on the performance of last night's Dow, Nasdaq, and whatever markets we've seen, and the bond market for that matter, they have promoted financial stability. At least for now, we think. Okay, why? Let's look at where the Fed views inflation. Sometime late last year, okay, the incoming chairman of Fed, Mr. Powell himself, he changed or he tweaked, okay, the Fed policies. And he basically said that, hey, look, yes, we're supposed to manage inflation, but we're going to manage inflation from an average point of view. What this means is that they're not going to be, I mean, first of all, I'm not sure, first of all, we all know that the Fed target rate is 2%, okay? So some months it can go above 2%, some months it can go below 2%. But as long as the average maintains around 2%, no worries about instability of financial system. I'm not going to do anything. I'll wait and see, and so on and so forth, which is what we are seeing right now. Okay, so the Fed basically, will keep this thing at 2% and will manage it from an average inflation point of view. Now, let me give you this example then. Okay, this is the same graphic as the one earlier. So this is what the Fed sees: 1%, 1.5, 1.5, or whatever, and then it goes to 2.6. The alarm bell started to ring, and they say, and then 4.2, and then they say, hey, look, it's transitory, it's going to come down. Totally, may not be totally wrong, may not be totally right, may not be totally wrong, but they are betting that this number will come down in the following months. Okay, obviously we know that today it's at 5%. Okay, but still, no reason for panic. This thing will come down. Let me give you, say, maybe an analogy. Okay, what this means is that if you were to buy, say, a loaf of bread, okay, in June last year, and it costs 60 cents for that loaf of bread, it goes up to $1, it goes up to 130, it goes up to 140, it comes back down to 120, and then so on and so forth. Okay, and then early this year it goes up to 2.6 or 260 a loaf, 4.2 last month, and this month it's $5 a loaf of bread. You're going to have to go to the baker or the bakery and say, hey, Mr. Baker, what's happening down here? Why is my loaf of bread that was $1, same loaf of bread, mind you, 1 year ago at $1, today costs $5? Okay, but wait, it doesn't just happen to your loaf of bread. It happens to your milk that you buy. Okay, it happens to the services, the haircut that you are paying your barber for. It goes up 5 times today versus where it was 1 year ago. Essentially, this is what it means. Okay, roughly plus minus. Okay. Now, if that's the story down there, then hey, it's okay if your salary has also gone up 5 times. But in reality, folks, I think many people are struggling to keep their jobs in view of what's happening in the world today, right? So, is this something to be of concern? Let me ask you. Okay, I would be really, really concerned. But hey, the Fed is not concerned because so far it is still transitory. Let's wait a few more prints. Okay, will it be 10% before the Fed starts to panic? I do not know. Or if the Fed is correct, it may come down to 3% and 2%, and on the whole average, it's going to be at 2%, which is what the Fed is trying to target. Okay. Now, what does the Treasury Secretary think? Meanwhile, this is Mrs. Yellen, ex-Fed chairman, now Treasury Secretary, also a very big mover and shaker out there where monetary policies and financial stability and all concerned. Okay, 1 month ago when the print came out, okay, on the April number, for example, Yellen basically said inflation. She said, okay, yes, there's a bit of inflation on there, but no need for a rate hike. This is May the 4th. Okay, just a few weeks ago, May the 6th. Yellen says, same thing, same Yellen, okay, says higher interest rates would be a plus report, okay? I mean, would be a plus. So she is basically saying that, hey, maybe we should be hiking rates, be a bit more proactive, okay, as opposed to reactive, as opposed to non-active. Now, the key thing down here is this: they do not know what's going on. I mean, I certainly don't know. They also don't know, okay? And I cannot fault them for not doing anything if they don't know. What I'm saying, let's be a little bit more concerned. Okay, now why should we be concerned? This is something we got from history, and this is again from the Federal Reserve. It's well chronicled down there because it was such a dark period of the Fed's time, the Fed's life in the history books, because that was when inflation went from a period of stability of around 5% year, shooting up to as high as 15% over a 20-year period time, from 1965 all the way to the mid-1980s, for example. And that caused a huge amount of pain in the system, okay? But the key point down here is, what caused, I mean, was it transitory? Was it bottlenecks? Was it whatever caused this thing to run up? Okay. There were a lot of arguments, but the key common understanding that everybody had was this point down here, highlighted down here, okay? While economists, let me just read to you, quote unquote, while economists debate the relative importance of the factors that motivated and perpetuated inflation for more than a decade, and this was a more than a decade period, okay? The origins of the Great Inflation were policies that allowed for an excessive growth in the supply of money, okay? There was little debate about the source of how that inflation came about. It was due to the aggressive monetary policy that they had prior to this period of time. Sounds familiar, folks? We are living that today. Why? We all know the balance sheet of the Fed, and that's highlighted by the fact that money supply in the system, okay, has gone up from below 1 trillion to 4 trillion, okay? This was due to the great financial crisis 10 years ago, 12 years ago, 13 years ago. And in last year itself, it doubled. Asset buying programs, QE, stimulus, very aggressive stimulus, okay? We all know this because of COVID. That's fine, okay? Still, something to be concerned. This has created real yield to actually collapse. Folks, a bit of technicality, real yield means, okay, yield minus rate of inflation. And real yield, as you see, is taking a dive, which is why meme stocks and higher risk stocks, higher risk, higher return are being sought after because everybody's chasing those stocks because of a very low and negative real yield effect. And remember, this period, real yield was also down to negative numbers. Okay, just to go back, it was because inflation was so high. Okay, just the point I want to make. Okay, at this point in time, I just want to ask, Royston and the crowd, I mean, in the audience, basically, this. Now, why is all this talk about inflation important? Okay, and I want to talk about inflation is important because I want to look at risk to you as a portfolio person managing your own investments. What does it matter to you, and why is all this talk so important? To begin with, okay, I've just given you 3 scenarios: scenario A, B, and C, and they look at 2 things, 2 elements in every other scenario. 1, valuation, and the risk. So the first scenario, when you get something that's high in valuation and high in risk, okay? Second one, high valuation, low in risk. Third one, low valuation, high risk, for example. In which of these scenarios do you think, okay, creates the most uncertainty, and with uncertainty, deem the riskiest for financial markets?
You're asking me?
I'll ask you, because I don't see anybody else in the audience.
I think scenario B, in my opinion, when the market is high valuation and there's a lot of complacency over there in the form of low risk, everybody is thinking that good time is going to continue, is going to party on, and that's exactly when when the music actually stops, everything starts collapsing pretty significantly. So and we can see low risk in the form of the VIX index being at all-time low as well. So that's where potentially that could be the highest risk, in my opinion. I'm not sure about what your explanation might be.
Yeah, folks, Royston is the man, and he's exactly right. Okay, he's highlighted B as the situation which could create the most uncertainty ahead. And uncertainty in the market player sense point of view is basically higher risk. Okay, and he has actually even broke it down, and this is something exactly what he's just said earlier. Okay, yes, he's right. When valuations are at the highest and risks are deemed the lowest, okay, or as perceived by the market, this is where I think things, your spidey senses should come up and be a little bit more alert to what could happen to you in terms of potential, meltdowns or sell down. Okay, so very quickly, this graphic, the blue chart highlights the Nasdaq, and Nasdaq is at quite an all-time, is the all-time high right now, which signals valuation at a very high rate. Okay, likewise, the orange chart or the orange line signals VIX. VIX is a measure of volatility index, and it also measures risk. Risk is now benign, if you're going to call it, okay, where this number is concerned. What I want to highlight is whenever VIX basically, and you look at this, there is an inverse correlation between the two. Right now, we are at this setup whereby, okay, high valuation, low risk could create a situation whereby we may go into a period of turmoil. As long as the turmoil is orderly, I'm okay. Orderly means a lot of people expect 10-15% discount. I mean, pullback. Why? Because market's been chugging along so nicely. And that's okay. That's orderly. If it becomes more than that, it goes crazy. There's a knock-on effect. There's a ripple effect. There's a risk to financial stability. Then that's where things can get a little bit messy. And that's basically our point. Okay, finally, what we think the Fed should do is exactly what most central bankers are starting to do right now, which is, number one, pull back on some of this stimulus, aggressive monetary policy out down there, asset buying, programs, etc., etc. New Zealand, Canada, China, and even Australia, okay, are all signaling a bit fearful. Why? Because inflation signal that, hey, look, we are normalizing. The Fed, meanwhile, is just happy to sit there and wait and see. And that, I think, to me, folks, is the biggest risk of the whole market at the current present. Okay? Questions, or over to you. I think Royston basically has many, many juicy parts, especially about how we should protect ourselves.
All right, thank you, Nicholas. Not very juicy, but let me take over and basically share with you basically what can be done, if let's say inflation were to really take flight. Okay, so I hope that everyone can see this. So we basically, Nicholas have covered points 1 and points 2. And what I'm going to cover on is what do we actually do right now? Let's say if inflation really takes shape in a much bigger manner. And even if it doesn't, and it stays pretty elevated at current levels, basically we should be looking to protect part of our portfolio as well. And that's basically what I would like to kind of like highlight in this particular segment. I think that previously when we actually did the inflation video, I actually have run through a number of very interesting points and asset classes to take note of. And I want to pull this chart back again, which is something that Goldman Sachs has actually researched on and highlighted to its clients, saying that which are the kind of asset classes that would actually perform the best in an inflationary environment. And right now we are probably in one whereby the inflation numbers are pretty high, more than 3%, and at the same point of time there's a fear that it might still be rising. And even if in the event that it isn't really transitory, and the fact that if inflation really starts trending higher and higher, potentially what are some of these key commodities or asset classes that we should be looking at? And the top 3 ones are your oil. This one is basically your commodities as tracked by the Goldman Sachs Commodities Index. And the third one is basically gold. And gold basically has been underperforming for quite a while over the last 1 year. This year is starting to kind of like rebound quite a bit. And at current level, there's looking at some form of resistance. So later we'll take a look at the chart as well. But interestingly, these are the 3 key asset classes that you should be kind of like looking to partake in if you believe that inflation is going to be running higher than expectations. So take note, oil, commodities, as well as gold. So let's take a closer look at each of them. So just now we talked about oil, and at this point of time, oil seems to be breaking higher from a triangle continuation pattern. So for those who are more technical savvy, right, you know that this could potentially be a bullish sign. And right now, I think that oil prices have kind of like hit $72. And potentially that is something that has been a key resistance level for quite a while already. And potentially if that trend can continue, its next key point to actually be looking at, or next key resistance to be actually looking at, is around the $87 per barrel level. So oil is actually something that a lot of houses are actually very bullish about. All right, very bullish about, and this is something that you should be looking to partake if you really do believe that inflation numbers are going to be high. Even if inflation numbers are not going to be that high, with the reopening and with demand actually increasing, potentially oil prices could continue to trend higher. So this is something that you should be taking a look at. And for me, I think a good way to actually play it versus just buying any particular oil companies is to actually buy a basket of these oil majors. And you can actually look to partake in that through the XLE ETF. So this XLE ETF basically have huge exposure to Chevron as well as ExxonMobil, as well as all the other oil majors out there. So this could be a safer way to actually partake in the rise in oil prices. So that's for oil. Next one is actually copper. Again, we have actually created a copper video, and basically Nicholas previously have highlighted his view as to why he believed that copper as one of the is one of the key commodities that is looking very positively, not just on the short-term basis, but also on the longer-term trend. In terms of supply-demand mismatch, potentially that could be a key catalyst in terms of long-term structural play for copper. So copper right now, there's some form of consolidation mode. It hits a high of roughly almost 11,000, and then now it's kind of like retracing back a little bit. So overall, the uptrend is still very significantly higher, and a lot of brokerage houses again are expecting that copper prices will continue its uptrend after some consolidation. And I think the best way to actually play it is again through some of this ETF. And the COPX ETF is basically one of the pure play copper miners. So basically when you buy into this ETF, you're buying into a basket of copper miners. So that is one way to actually play the rise in copper. Another way which I kind of like is also to focus on this ETF called the PICK ETF. So this particular ETF, the difference between COPX and PICK is that for the PICK ETF, it's actually consists of more diversified large cap miners. So potentially not as volatile. And I think that in our last video that we have created, I highlighted that this particular ETF has been a very consistent outperformer over the last 5 years versus the S&P 500. So that is something very interesting. So do check out our previous video as well to find out more about this particular ETF, all right, and what basically it consists of. So copper is one way that generally I'm personally quite positive on, and definitely one way to play the inflation game. At the same point of time, gold, which is the traditional asset class to actually hedge against inflation. Right now, you see that this year, there's some form of rebound. Early this year. Right now, again, meeting some form of resistance at this current level. There could potentially be a pullback, or potentially it could also go higher. So we have to actually check out what might be the share price on the technical basis. But overall, gold, I think, is a useful asset class to at least to have as part of your portfolio positioning strategy. And one of the easiest way to actually do it is to buy the GOLD ETF. So this particular ETF tracks the underlying gold performance. Or alternatively, if you're less risk averse, you want to take on more risk, potentially you can be looking at the gold miners. So this one is going to be, this GDX ETF is going to be more leveraged, more volatile, so to speak, but potentially the upside could be significantly more if gold prices does actually starts rallying. And the key focus over here is whether or not it can breach its all-time high of 2075 per ounce back in sometime in mid-2020. So that was the last high. Whether or not the current uptrend can actually breach its last high, and if that's going to be the case, most likely it's going to be driven by inflationary fears. Right. So those are the few key asset classes. And last but not least, again, this is one particular commodity, palladium, that is not exactly a good hedge, but just wanted to highlight that in terms of the structural uptrend, this is one particular asset class that you might look at to actually hold on to for long-term structural play. All right, so on a long-term basis, or at least for the last 5 to 6 years, it has actually performed extremely well. So palladium is actually a commodity that's used in automobiles, basically in auto catalytic converters, basically to convert all the harmful gases into less harmful gases. So that is something that is going to be continuously in demand moving forward as well. So check that out, and you can get exposure through the PALL ETF. All right, so those are the few key ways to actually play a higher rise in terms of inflation that I just want to highlight to the readers as well as the viewers. Not really something that you should be partaking it aggressively, but really have a small portion of your portfolio to be buying into this kind of commodity plays to kind of like hedge the risk of inflation moving forward. And last but not least, I would like to end this video with this particular picture, which basically shows us what the Fed wants us to think. And right now, everybody wants us to think, not just the Fed, but a lot of the market players out there wants us to think that inflation is transitory, and they're feeding us this transitory pill to us, and wanting us to believe that that's going to be the case. But I guess that just now Nicholas had put up some very interesting charts and diagrams as well, which shows us that potentially this might not be the case. All right, the high CPI numbers might not be the case. And one very interesting one that I kind of like is when he actually showed that, you know, the CPI component breaks down, and the fact that food theoretically, it's lower in the month of May, which is something that I'm quite curious about and wanting to track its performance moving forward, because everywhere we go, we are hearing of all these supermarkets actually increasing their prices because the raw material costs are higher, and therefore they're trying to pass it on to consumers at the end of the day. So I'm just not sure and scratching my head as to why is this component, the food component, not a bigger component in terms of contributing to the rise in CPI. Is there a lagging effect? I don't know, but potentially if that's really going to be the case, then that is something to be really mindful about. All right, so just like to end this on this note. Hopefully this video again is something that is useful for you guys and something that you guys actually enjoy very much. Once again, Nicholas, thank you for your time.
Thank you so much again, Royston, for having me. And I think very good arguments that you've made, good ideas, and hopefully, I think viewers like it or enjoy this enough to share it and to also like the video.
Yeah. So if you do like the video, do remember to share it with your friends and join our NUF YouTube channel as well. Okay. So with that, thank you everyone. We'll see you guys in the next video. Bye bye.
Thank you. Bye bye.